There is a 401k statement sitting in a drawer in a house in Tulsa, Oklahoma. $218,000. It has been in that drawer unopened for 2 years. The woman who owns it is 61 years old. She still works 4 days a week at a job. Her back stopped tolerating somewhere around her 58th birthday. She has told her daughter more than once that she just has to hang on until 65. That's when the money becomes available. That's when you're allowed to stop. That is not true. It was not true 2 years ago either. That account came unlocked the day she turned 59 and 6 months. Not 62, not 65. 59 and a half to the day calculated by the IRS, down to the month, not the birthday, not the calendar year. On that exact date, the single biggest legal barrier standing between her and her own savings was removed. Quietly, automatically. Nobody sent a letter. Nobody called. The IRS does not notify you when the penalty on your own money expires. So she worked 2 more years for a wall that was not there. She is not unusual. She is the default. Before I go further, I'm not your CPA, I'm not your attorney, and I don't manage your money. What follows is education, and it's accurate, but the specifics of your situation belong in front of a professional who is paid to look at your actual accounts. Take this seriously enough to go check. That's the whole ask. Because there are 3 separate doors here. One of them opens at 59 and a half. One of them can open 4 years earlier than that. And there is a single, extremely common paperwork move that slams it shut forever. And the third one has a hidden clock running on it that most people have never once checked. And if that clock hasn't finished, the money you think is tax-free is not. Let's go find out which of them are already open for you. If you are 58 right now, this is about the next 18 months of your life. If you are 59, this is about a date that is already on your calendar and you don't know it. And if you are past 59 and a half and still telling yourself you have to wait for something, then this already happened to you. The barrier came down. You just weren't told, so you kept behaving like it was still there. I want you to do something right now before I explain the mechanism. Take your birth month. Add 6 months to it. That is the date, not your birthday. Not January of the year you turn 60. Your birthday plus 6 months. Write it down, because in about 4 minutes, I'm going to explain exactly what that date does to your money. And I want you looking at it while I do. Go ahead and put your age in the comments too. I'm serious about that one. I read them, and it tells me how many of you are sitting right on top of this date without knowing it. Say 58, say 64, say whatever it is. You'll see very quickly that you are not the only person who was never told. It goes unsaid for an ordinary reason. Nobody in the chain has a job that includes telling you. HR handles money going in, not coming out. Social Security talks about 62 because 62 is their number, and Medicare talks about 65 because 65 is theirs. And neither of those numbers has any authority over the money in your IRA. The IRS runs the actual rule, and the IRS collects, assesses, and enforces. It does not advertise. So the rule sits there, published, public, completely legal, and functionally invisible, because every institution you'd expect to hear it from is talking about a different age. That is how a woman in Tulsa works 2 extra years for a wall that came down in the spring of the year she turned 60. Now let me show you exactly what the IRS takes before that date and exactly what stops on it. Internal Revenue Code Section 72, subsection T. That's it. That's the wall. One subsection of the tax code. And it is the single reason an entire generation believes their own savings are locked away from them until some later, vaguer, more official-sounding age. Here's what it does. If you pull money out of a traditional IRA or a 401k or a 403b before you are 59 and a half, the IRS charges you an additional 10% tax on the amount you withdrew. 10%. On top of everything else you already owe on it. And I need you to hear the words "on top of," because this is where people get the mechanism wrong in a way that costs them. Say you have $300,000 in a traditional 401k. You are 57. Something happens, a roof, a diagnosis, a layoff, and you need $40,000 out of that account. That $40,000 is pre-tax money. You never paid income tax on it going in. That was the deal. So when it comes out, it lands on your tax return as ordinary income. $40,000 of it stacked on top of whatever else you earned that year. Depending on your bracket and your state, that is a real bill, and there is nothing unusual or unfair about it. That's the trade you made when you deferred the tax. Then the IRS applies Section 72 ETIR on top of it. 10% of $40,000 is $4,000. That $4,000 buys you nothing. It isn't deferred. It isn't credited back. It is a penalty assessed for the sole offense of touching your own retirement savings before a specific date on the calendar. You wanted $40,000 of your money. $4,000 of it is gone purely as the price of timing. Now here's the flip. On the day you reach 59.5, that 10% stops. Not phases out, not reduces. Stops. Section 72 no longer applies to distributions from your IRA, and it no longer applies to most employer plans either. Your 401k, your 403b, your qualified plans. Same account, same balance, same withdrawal. The $4,000 penalty on that $40,000 distribution simply does not exist anymore. And it is the date specifically, not the year. This is the part people get burned on. 59.5 means 59 years and 6 months measured from your actual date of birth. If you were born in October, you do not reach it in January when the new tax year starts, and you do not reach it on your 60th birthday. You reach it in April. Somebody born in October who takes a withdrawal in February of the year they turn 60 is still, in the eyes of Section 72 ET, early, and gets assessed the full 10% on a distribution they were 2 months away from taking for free. 2 months, $4,000 on a decision that felt identical either way. Now, I have to be straight with you about the other half of this. The penalty stopping does not make the money tax-free. Pull that $40,000 out at 61 instead of 57, and you still owe ordinary income tax on it. Every dollar, it still stacks onto your income for the year. It can still push you into a higher bracket, and it can still have knock-on effects on other things in your life that are key to your income. What ends at 59.5 is the punishment, not the tax bill. What 59.5 actually gives you is this. From that day forward, the timing of when you touch your retirement money becomes a decision instead of a penalty. You get to choose the year, you get to choose the amount. You can pull $60,000 this year and nothing next year and manage your own bracket around it. And the IRS does not charge you a fee for the privilege of choosing. If you have ever caught yourself assuming your retirement money was locked up until 62 or 65, put yes in the comments. Not as a joke. I want you to see the number. It is going to be most of the people watching this, and every single one of them was told it by somebody who simply did not know. Now, everything I have just told you is the rule that applies to most people, but there is a version of this where the door opens 4 years earlier, at 55, and it is completely legal, and it is sitting inside a plan that a lot of you already have. There's just one move that destroys it. And it's the move most people are advised to make. The rule of 55. If you separate from your employer, quit, get laid off, get fired, retire, it does not matter which, in or after the calendar year you turn 55, you can take money out of that employer's 401k with no 10% penalty, starting at 55, 4.5 years before the date I just spent 5 minutes explaining to you. A few specifics, because this rule is narrow and the details are where people lose it. It is the calendar year you turn 55, not your birthday. Turn 55 in November and leave the job in March of that same year, and you qualify. The year is what counts. It applies to 401ks, 403bs, and the federal thrift savings plan. If you are in public safety, police, firefighters, certain federal categories, the age drops to 50, and this is the one that matters most. It applies only to the plan at the employer you just left, the current one. the most recent one. It does not cover the 401k from the company you left at 48. It does not cover the one from the job before that, just that plan at that employer that you separated from at 55 or later. And it does not apply to IRAs at all, ever, which brings us to the part that ruins people. You leave your job at 56, somewhere in the next few weeks. Someone tells you to roll your old 401k into an IRA. It might be a broker. It might be a well-meaning friend. It might be the plan administrator's exit paperwork, which practically walks you to the door with it. And the advice isn't wrong. An IRA usually means more options and lower fees. Except you just separated from that employer at 56. That 401k was penalty-free to you the moment you walked out. And the second it lands in an IRA, it stops being a 401k and becomes an IRA. And IRAs have no rule of 55. You just move money that was fully accessible to you into an account where it is penalized until 59 and a half. Nobody flags it. There is no screen anywhere in that process that asks how old you were when you left. You did the tidy, responsible looking thing, and you traded away 3.5 years of access to your own money to do it. And it does not reverse. You cannot roll it back into the old plan to restore the exemption. The employer relationship is over. That door is shut. Now, if you are already past 59 and a half, this costs you nothing. The two ages have converged and the rollover is just a rollover. This trap is aimed squarely at people between 55 and 59 and a half, and that is a very specific window. And if you are standing in it right now with paperwork in front of you, stop and read it again before you sign. If you left a job at 55 or later, go find out what happened to that 401k. Did it get rolled? Is it still sitting with the old plan? Tell me in the comments. And if you know somebody who just retired early and is about to consolidate everything into one account because it feels cleaner, send them this. That's a 5-minute conversation that is worth thousands of dollars to the right person. So that is the door that opens earlier than 59 and a half. But there is one that has no age on it at all. None. You can walk through it at 52, at 48, at 40. It is fully legal. And the IRS publishes the instructions for it. It is also the most dangerous thing in this entire video. Substantially equal periodic payments. Section 72T, subsection 2, paragraph A, clause 4. Most people call it a 72T schedule, or SEPP. Here's what it lets you do. You tell the IRS you are going to take a fixed stream of withdrawals from your IRA, calculated by one of their approved formulas, and you commit to taking it on schedule. In exchange, the 10% penalty does not apply at any age. 48, 52, 56, the age requirement is simply gone. Now, the price. Once that schedule starts, you are locked into it for 5 years or until you reach 59 and a half. Whichever period is longer, not whichever is shorter, longer. Run that against a real age. Start a SEPP at 58 and you do not finish at 59 and a half. 5 years is the longer period, so you are locked until 63. Start it at 45 and you are locked until 59 and a half because that's 14 years and it's the longer of the two. And locked means locked. You take exactly the calculated amount on the schedule every year for the full term. You cannot take more in a year the furnace dies. You cannot take less in a year you didn't need it. Roll the account, add to it, take an extra distribution out of it. Any of those can break the schedule. Here's what breaking it costs. The IRS does not just penalize the payments you got wrong. It goes back to the beginning. Every distribution you took under that schedule from year one forward retroactively becomes an early withdrawal subject to the 10% penalty, plus interest on every one of them. So 52 years old, $16,000 a year for 6 years, $96,000 withdrawn, all penalty free. Year 7, you need $8,000 extra for something you could not have predicted. You take it. The IRS assesses 10% on the full $96,000. $9,600 plus interest running back to the first payment in a single tax year, triggered by needing $8,000. That is why this exists in the code and almost nobody uses it. It is a legitimate, legal, IRS published escape hatch that punishes you savagely for having a life while you're inside it. If you are anywhere near 59 and a half, waiting is almost always the better answer. This tool is for people with a genuinely early need and no other assets to bridge it. And it is not a thing to set up off a YouTube video. That one goes to a CPA in writing. So that's the third door, which leaves the account most of you are counting on hardest, and the one where 59 and a half by itself is not enough. Roth IRAs get treated as the account you don't have to think about. You already paid the tax. It grows tax-free. Take it out tax-free, half right. There are two conditions, and hitting 59 and a half only satisfies one of them. For a Roth withdrawal to be fully qualified, no tax, no penalty on the growth, you need to be 59 and a half, and the account has to have been open 5 years. Both, not either. And the 5-year clock is not what people assume. It does not start on the day you open the account. It starts on January 1st of the year you made your first contribution or conversion to any Roth IRA, any of them. Open one in December of 2022 with $50 in it, and your clock started January 1st, 2022. You got most of a free year. The clock also carries. Once it starts on your first Roth, it applies to every Roth IRA you open afterward. You do not restart at zero each time, which cuts both directions, and this is where it bites. Somebody who is 58, has never had a Roth, converts a chunk of their traditional IRA in March, turns 59 and a half the following year and goes to pull the growth out, is not qualified. Age, yes. Clock, no. That clock runs to January 1st of the 5th year out, and they are years short of it. The contributions themselves, you can always pull back out tax and penalty free. That's your own money, already taxed. It's the earnings that get caught. Pull earnings before both conditions are met, and you're looking at ordinary income tax on them, plus the 10% on money you were sure was untouchable. So the person who was most careful, who paid the tax up front specifically so retirement would be simple, is the one who gets surprised at 59 and a half because they were counting one number and the rule counts two. Do you know the exact year of your first Roth contribution? Not roughly. The year. Put it in the comments because I would bet most of you would have to go dig for it, and it's the number that decides whether your Roth is actually ready for you. All right, 3 doors, 3 sets of rules. Here's how you find out which ones are open for you. Today, not eventually. Now, I want to be honest with you about what you just learned because there's a version of this video that lies to you at the end, and I'm not going to make it. Nothing I've told you put $1 into your account. The penalty coming off at 59 and a half removes a legal barrier. It does not solve a math problem. If you don't have enough saved, 59 and a half doesn't change that, and no rule in the tax code is going to. What it changes is who's holding the decision. Before that date, the calendar decides when you can touch your own money. After it, you do. And if you've got enough, then yes, the thing standing between you and the end of that commute was never 65. It was a date that already passed. For a lot of you, that's the whole discovery. Not that you're rich, that you were waiting on a wall that isn't there. So go check. Today, not eventually. Your birth month plus 6 months, that's your date. And if you left a job at 55 or later, call that plan administrator tomorrow and find out whether that 401k is still sitting where you left it. Because that phone call has a deadline attached to it that nobody is going to remind you about. $218,000, Tulsa, still in the drawer. That account was never locked until 65. It came open the day she turned 59 in 6 months, and it has been open every single day since, through 2 years of 4-day weeks and a back that stopped cooperating years ago. Nobody took anything from her. That's what gets me about this one. There was no villain in the room. There was just a rule she never heard and an entire system with no reason to say it out loud. Go find out what your date is.